commodities, especially, you go from underinvestment to overinvestment. And typically periods of low volatility are followed by periods of high volatility because of underinvestment. And I think that's a real theme, investment in commodities in general, which has laid the ground for what we've seen for the last few years. And I think it's actually only starting.
Welcome to The Derivative by RCM Alternatives. Send it.
Hi, this is Stephane Bernhard. I'm the CEO, CIO of CAM Multi-Strat Asset Management, part of ETG Group, and I'm here to talk about commodities, Podshops, and more on the derivative.
Thank you, Stephane. Now let's start. What's the proper pronunciation? Stephane? Stephen?
Yeah.
Stephane?
Stephane.
You get it all?
You got it.
And we were just talking before we started, you're in a hotel in London, but where are you usually posting up?
Yeah, so I live in Paris, but we have our headquarters, ETG headquarters in Amsterdam in the Netherlands. And I spend a fair bit of time in New York, where we have the headquarters of our asset management firm, Commodity Asset Management. And we're based in New York on 6th, close to Central Park. Yeah.
What's it like living in Paris?
It's really by choice. It's been, I've lived outside of France for 20 years, a long time in Spain, in Madrid, and when my kids were at the age of getting to university was the time to get back to Paris. But I must say it's been very exciting. This city has something special. So enjoying it. Yeah.
Now I'm torn whether to come visit you in Paris or in Amsterdam. Never been to Amsterdam. I've been to Paris.
Yeah, well, you know what? Amsterdam is a really lovely city. I actually listened into the pods you did with the founder of Transtrend, which I found interesting.
Yeah, we're doing like a tour of Holland here, right?
Yeah, I can see that. And he was mentioning that Amsterdam is the place where the Dutch people spend the money, and that's true. It's a very lovely city.
Do you know him personally or no?
No, unfortunately not. It's already something we need to organize, maybe through you. Yeah.
Is there Amsterdam versus Rotterdam? Is there like a?
I think so. In Rotterdam, you got really the commodity hub, the historical commodity. Many commodity firms are there, and I guess Amsterdam is more the tourist city. But
We'll take it. So yeah, let's start with a little bit of your personal background.
Yeah.
And then we'll dive into what you're doing on the commodity side. But yeah, how'd you get into this crazy business?
Yeah, so I actually started my career as a fundamental grains and oilseeds trader with Louis Dreyfus in '94, and I was very lucky to start in Paris in that firm, learning, surrounded by a lot of talented people, and in a moment that was quite special. The mid '90s was a period where you still had in those places big firms an information edge, and so it was really interesting to see that. And but at the same time, it was the start of a transition in the commodities world, and that then pushed me into looking into many different ways into commodities, not only the supply demand driven fundamental view, which was the backbone of what I learned in Louis Dreyfus, really. And so it's been a very interesting period.
And was Dreyfus mainly cotton still at the time, or they had expanded?
Cotton was very big with Joe Nicosia, obviously, but it was grains and oilseeds, and very big in grains and oilseeds, actually bigger in terms of size than in cotton. But cotton, sugar, coffee, so all the ags really, and then the group diversified in other stuff, including energy, and it was a very lively place. And I was with them between '94 and 2007, and then I was doing a bit of a round. I started in Paris, then I was in Germany, in Hamburg for a year, and then they sent me to Madrid as the head of trading for the office there. That was in '98.
Nice.
And that was really super interesting because that was a very big office, very complex, trading many different commodities, agricultural commodities, and as I say, that was at times where things changed quite fast in those years, and that's when China came in our market, in the commodity market, as being a very big factor. and as well CTAs. CTAs started to really be very important in agricultural commodities at the end of the 90s. And then I think one of my best experience back then was actually for 2 years to be in the dry bulk freight, which is probably one of the most exciting commodity in terms of volatility, complexity. With a very strong team back then in Louis Dreyfus, and there it opened my eyes to the macro really, and coming with a different angle to commodities.
And one of the most volatile markets too, right?
Yeah. Till today, yeah.
What was the average volatility of that?
Off
the top of your head.
I mean, still today, so what happens in freight is that you have the nearby, that the cash positions that are extremely volatile. For Cape sizes, you have daily moves of 20% today. And then the curve, is less volatile, but still it's very trendy, very volatile. And so Cape sizes are the most volatile. The smaller sizes are less volatile. But grain houses and freight traders, they typically trade in the so-called Panamax size, which is the maximum size that vessels can cross the Panama Canal, and Cape sizes, which are able to go around the Cape. And those sizes, you have to be learning risk management, really. It's about risk management and respecting the volatility in market, which it's always a good thing to learn as a commodity trader.
And the idea there is the next week I might decide I'm not going to make that shipment or whatever, and the price is very volatile on the short term, versus longer term we know we're going to have to ship this stuff eventually.
Right. I think the longer term, it's very interesting. It's been used historically and still today by macro trader and more directionally driven people that express a macro view for freight. We always mention Dr. Copper as being the commodity that reflects more the macro environment. Dr. Copper is important to understand macro, but probably freight is more so, in my view. It really reflects where the tension in terms of global flows and what the world needs, and do we have enough transport to respond to the growth of global commodity flows. And so freight is a really, really interesting. I learned a lot in those years, and we're actually still trading it quite actively.
Nice. And I can't let you go on Louis Dreyfus without mentioning, for our listeners who don't know, that in America, the Louis Dreyfus name's famous from Julia Louis Dreyfus, but she's a heir of that fortune, right?
Yeah,
she's related.
She's the daughter of William, that was the chairman and major shareholder when I started my career there.
Yeah. Did you ever meet her?
No. Or the members of the family, but not Julia.
Yeah. So all you Seinfeld Veep fans, she's commodity, old commodity money. Absolutely. Never had to work a day in her life, probably, but she's done well.
Yes.
All right. So you're Louis Dreyfus. Then where'd you go?
Then I've been, I was 37, had quite a bit of an active career, and then I thought, it's time to do something else. For 7 years, I wasn't working for anybody. I was really running my own businesses, investments as a business angel. Was living in Madrid back then, 2007 to 2014. It's been quite a rocky period in the history of Spain, with quite a bit of, almost a depression, really. So it's been a very steep learning curve to be an entrepreneur in that country, in that time. And you
that's like the sovereign debt crisis and huge, absolutely, like 30% unemployment. What did Spain have? Something huge, right?
It's been huge, and it was really on the back of an over-leveraged banking system in Spain back then. And some things that are still today, the Germans not spending enough money, but happy to lend to Spanish banks that were over-leveraging the property market. So but the burst of that was quite intense. And there again, you go through very interesting periods as a macro trader, commodity trader. You recognize some tensions there that can be helpful in your decision making, but nevertheless, when you're in an environment like that of a depressing economy, it's been a challenge being an entrepreneur. And Then by 2014, I had to get a job again
Yeah.
after not being extremely successful, let's say, as an entrepreneur. And came back in the commodity industry as the managing director of In Vivo trading. In Vivo are the French agricultural cooperatives. It's quite a big entity, and there I was running the trading arm, and was a very complex space, very different from my natural space, I would say. Cooperatives is a different setup than a commodity firm or a fund. And so I brought a lot of trading skills, I guess, and risk management, and we try to turn this thing around. It's been quite intense, learned again a lot. But the most important thing I learned that's the only period in my life where I was not a full-time trader or a trading manager. And being a CEO, was something that was very interesting. But that, I think, the biggest learning for me in this period was that I realized how much I was missing trading and the love of trading, the process. And so when I left in 2019, that's when I had a great opportunity to join forces with an ex-Louis Dreyfus colleague, who's the CEO of ETG Commodities. And ETG Commodities part of ETG Group, a conglomerate that is with African footprint, and around 8,000 employees in 42 countries, active in fertilizers, seeds, logistics in Africa, fast consumer goods, specialty commodities that don't have a futures market, a derivative attached to them, like cashew, nuts, those type of specialties. And then the commodity division that we run. So our CEO, Ronald Jetten, and myself realized we share a vision. And when we met in June 19, and we were very lucky to have our shareholders that fully back that vision. And ETG Group is it reminds me a lot of Louis Dreyfus. Our shareholders, they are traders themselves. They're deeply knowledgeable in trading and risk management. And another thing that is interesting, this group, 35% of the group is owned by Mitsui, the huge Japanese conglomerate, and that brings a lot of structure as well. So we have, in my view, a bit the best of both worlds, having shareholders, majority shareholders that are traders. Reminds me again a lot of the Louis Dreyfus genetics. And at the same time, I'm Mitsui, and in ETG, it's really been fascinating, because it's we trade all the commodities, agricultural commodities, industrial metals, energy, freight, and we're highly diversified. But our edge is Africa, and out of that, the vision was to say, how do you connect global prop trading, so derivative-based, with physical footprint, and how does those, what's the synergy there from the bottom up, from the physical into the derivatives, and derivatives into the physical to take the best decision in terms of risk for the firm. And that's been 5 years.
Back up for a second. Describe whether it was Louis Dreyfus or, right, people are familiar with Glencore and some of the big commodity trading firms. Like what are they trying to do, right? Everyone hears commodity trading, but in our world, people are trading on the screen and getting in and out of corn futures or options. But what are these commodity houses trying to do at the end of the day?
At the end of the day, if you really think about that, those firms, they built a bridge in time between commodity producers, whatever type of commodities, and industrial end users that need the commodity. And why I'm going to say bridging in time, agricultural commodities get harvested during a short period of time, and then they need to be supplied to the global market every month, obviously, over the year.
Before they spoil or whatnot.
Yeah, and then even for industrial commodities, it's the same story, right? If you have to give an incentive to producers to pull crude oil, out, refine it, and then bring it to market. And those commodity funds, what they do, they take decisions based on their assessment of supply demand, and in a way build that bridge in time. And without that bridge in time, you don't have the ability for producers to sell when they want to sell or to secure their margin. And at the same time, you wouldn't have the ability for industrial users to get a coverage of to commodities that are not even produced yet. Right?
Yeah.
At bridging time, that's the first function. The second function that it's
So, and real quick on that, so that's via forwards and just contractual, like, okay, I'm letting you buy this that hasn't been produced yet into
yes,
forward in time. Here's what our pricing is going to be.
absolutely.
And then so they have huge risk based
Yes.
on that alone, because if the price spikes and they've locked in here, so now the game is to manage that risk.
Absolutely. So that's where derivatives come in play. So those commodities, as you know very well, Chicago Board of Trade was created on the back of agricultural commodities, and the derivatives market, the roots of derivatives market, it's not the Standard and Poor's 500 or bonds for that matter, right? It's agricultural commodities, because you need those derivatives to hedge and to manage the risk of those inventories or forward contracts that you sold for a commodity that isn't even produced yet, right?
Yeah.
The bridging time, it's a critical function. Without those commodity firms, the world economy could not function. And then the second function is financial. I mean, you're financing inventories, you're financing, you take risks on counterparties, and you have to know both producers and end users. And so there's a financial risk that requires a fair bit of complexity and expertise. You deal with difficult countries, different currencies,
Regulations, yeah.
regulations, absolutely.
So that's right to me, and it just popped in my brain of like, wasn't Bitcoin supposed to solve all this? Right? Like the blockchain of, because to me, it's like, why don't some of these largest producers, and maybe they do, and I think they do, go direct to the, right, or the largest consumers,
Yeah.
Alcoa or something I'm thinking of. I don't know if they have their own aluminum mines or what, but why don't they go straight to the producers and cut out these commodity firms?
Because the probability that when Alcoa wants to secure its aluminum matches precisely the moment where the producer is willing to sell is very low.
Mm.
So the commodity firm in the middle takes a view and creates that bridge. So it can
Makes
happen.
a market, right? It's like a big physical market maker, essentially.
In a way, yeah. Plus, managing all the risks attached to them. Again, it's the price risk that we've mentioned, the financial risk, and then the logistical risk, right? You still move commodities that are physical goods, and the complexity of storing, transporting. It's an expertise by itself. So those are the different elements. And very often in the commodity business, at least when I started, you actually start your career by spending a fair bit of time in the logistic department and the operational department. You have to know your contract. You have to understand the footprint, the logistical footprint. So it's a very interesting space, because it's multidimensional, and and for a risk taker, I guess it gives you a different genetics than if you start trading FX or bonds, where in a way you're in a world that has a certain dimension. If you start your career in the physical commodities, it's one of the things that I find is useful is that you have to think in multi-dimension. You cannot just focus on one single dimension, and that's been I've seen very good commodity traders. The best commodity traders are people that have been embracing those multidimensional aspects of the commodity sector.
And which is odd, because you'd think it's simpler, right? Of like, oh, they're just growing this grain and you buy the grain and ship it here, and it's like a simpler thing than owning a stock or analyzing future cash flows or whatnot. But
I think everything is complex. You cannot, I'm not making the statement it's more complex. I think what it is, it obliges you for certain plasticity, mental plasticity, and because you have so many dimensions to take into account. So,
and you're saying like the trading house also might be, right? Our Alcoa example, cool, we did this contract, we owe them this aluminum, or you say it better, aluminum, however I say that in my European English. now there's a trade there of like, okay, I could deliver it from this hub and pay X. I could deliver from this hub and pay Y. Y is
Yeah,
cheaper. Now let's switch around all the logistics. So the logistics becomes part of the trading
100%.
as well, right? Not just
100%.
we need to get it there because we have this contract. How do we get it there as cheaply as possible and
And
earn?
here, that's what some you've probably heard the story of those soybeans cargo that have been shipped from Brazil to China, and by the time they reach China, they've been
Yeah.
sold a few times. And why is that? It's because when you have a commodity book, you create optionality, and you actually acquire optionality by having sales, purchases. Then you can start to turn around, and depending on what your derivatives do, certain commodities, then the basis risk is very high, but the basis creates an optionality. So yeah, it has that multi-dimension that is, and still today, we probably will get back to that. But in the derivative space today in commodities, the impact of the physical distortion in a way in price discovery is still sometimes the most important driver of price. Not always. Sometimes the physical side, and I think it's what was the vision we had with the ETG is to say, how do you connect that, right? Are you able to both understand the financial side of derivatives, what as most screen traders would look at, but at the same time, understanding when the physical may be the main driving force or not, and that I find is a very fascinating
And you think those are the three big, basically supply, demand, transport, and financing? Those are the three big movers, price movers?
No, that's only on the physical side, right?
Yeah, yeah,
So
yeah.
if on price moves globally, I would call that the cash. So within what moves the cash, those are the three elements. But then on the overall price discovery on crude oil or copper, you have the physical, but then you have all the rest, right? Which typically screen traders would track, and macro, the dollar, sentiment, geopolitics, and
Yeah.
CTA, systematic strategy. You have all those drivers. And what is very interesting in commodity, and I think that's the difference. If you trade stocks, at the end of the day, if you think about it, what you have to have an micro expertise on that particular stock. You probably have to have a view on the sector. And then, okay, the macro, it can have a systemic impact, but you could be a stock picker and still hedge out the macro through the index. Or at the very least, you just take the macro as your background picture, but you can trade your stocks just focusing on the micro. The problem with commodities, again, is that sometimes it's the physical, the micro, the idiosyncratic variables of the commodity itself that drive.
Yeah.
Sometimes it's totally overrun by the dollar or geopolitics or actually CTA. CTAs are, our friend from Transtrend. Those people can have a very significant impact on especially in turning points and acceleration points, right? And so
Yeah.
you cannot really separate them, I think.
Last bit, then we'll go into Cam of how
Yeah.
directional is ETG or any of the larger firms as far as you know, like how much directional risk are they actually taking on, or do they prefer to have zero directional risk and just earn the spread when they can?
In an ideal world, those firms, and for many of them, if you look at the biggest so-called ABCDs in the grain and the Trafigura, Mercuria, Vitol, etc., you would, in an ideal world, they would like to be able to hedge out their direction risk and capture those relative value and cash the carry, for
Yeah.
example, or just secure their industrial margin, transformational storage, etc. That's the ideal world. No, the real world doesn't allow for that.
Yeah.
You don't have
It's
the
too
luxury.
It's too hard, or it's too quick, it's too all the above.
Yeah, I think it's, you have to have a view on the market and be able to express it to bring down the risk to acceptable levels that are, that fit the mandate that you get from your stakeholders. But the reality is that so many firms, they just try to pretend they don't trade. That's It's not the reality. The reality is that you have to take a view, and you have to risk manage by using all the possible tools. And that's why, at the end of the day, for commodities in the derivatives space, hedges and the commodity firms still play a big role, because you cannot do without the risk management. And so I would say it all depends which firm, to answer your question, Jeff. I think some commodities allow for a lower directional price exposure. So take, for example, coffee. Last year was a very special year directionally in coffee, but for many years, because there's been a downstream effort with quality and sustainability, etc., you came to a point before the rally last year, and probably that's one of the reasons as well why the rally was so intense, that the basis volatility on the basis, or the size of the basis compared to the total price, was quite high. And I think what we see the last few years, what I find very interesting as well, is that there's the convergence of the physical commodities with the derivatives has lowered. So what I mean with that is the world got more complex, and that creates a very interesting environment as well if you are positioned as is CAM on trading purely derivatives. If you want to get an exposure on derivatives in commodities and you don't have the link to the physical, it's actually more challenging today than 10 years ago, 15 years ago, because the physical side of the equation is actually more volatile than it was in the past.
And for your coffee example, we're saying that people want Sumatran GMO, non-GMO beans, blah, 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 and that doesn't tie directly to the futures contract. And then how do I hedge it? How do I?
Absolutely. So when
Yeah.
the prices
Yeah.
were low and derivatives were not as volatile as the recent environment, the price that you were paying for that coffee was maybe 3 times or 2 times, at least 2 times the price of the derivatives.
Yeah.
Now, whereas if you trade corn, US corn, it will be a fraction. The basis will be a fraction of the derivatives. So some commodities have decommoditized in a certain way during a period of time when commodities were less volatile. What I find again very interesting is those are cyclical things, and in commodities especially, you go from underinvestment to overinvestment, and typically periods of low volatility are followed by periods of high volatility because of underinvestment. And I think that's a real theme. We've been cooking an environment, say between 2014 and 2020, 21. We've been in an environment of gradual underinvestment in commodities in general, which has laid the ground for what we've seen for the last few years. And I think it's actually only starting. And I'm not saying by that statement that commodities are bullish. That's not the topic. Commodities
Yeah.
are bullish and bearish.
Although there's a lot of good literature out there. That malinvestment is like extremely bullish, but we'll leave that be for now.
Absolutely.
And what's interesting to me along these lines, you'll see CME comes out with like the pork cutout future or the new Southern Pine
Yeah.
future, because lumber was mostly Canadian this, and they're like, well, all these US builders are using Southern Pine. So the basis, what I feel like if the basis gets too big, they'll launch another futures contract.
Yeah,
But
it's a way
in coffee,
to
how do you do that? There's 700 coffee contracts. Yeah.
do it. Yeah, absolutely.
So let's get into, you touched on it there. So all this ETG background, then you guys did a deal with Cam
Yeah.
to start trading a model that's informed by the physical. Explain what
Yeah.
CAM is and
So
how that all came to.
the vision when we kicked off, when we took over the management of ETG Commodities in 2019, with the senior management team, and especially with Ronald and myself, we had this thought that, as a firm, based on everything we said so far, as a commodity firm, you run so many risks, right? And you have to deploy so much resources to trade and to perform your function. And you do that with a mandate to protect and to deliver the best possible risk-adjusted return to your shareholders, and to make sure that you mitigate as much as you can the risk, because banks don't like to fund you if you take wild risks in terms of speculating on commodities. So that know-how, that was the core of the know-how that I've learned in Louis Dreyfus as well. And when you think about it, what it means is that that expertise, we apply it to a restricted pool of resources within ETG, even though it's a big firm, but there are so many different businesses.
Yeah.
The shareholders can only allocate a certain part of those resources to us, but the expertise, we can actually leverage it off. And us, remember, one of the big edge we need to dig out is the tracking the supply demand of each commodities, tracking the ability to deploy and be aware of what the commodity environment is on the physical side. So that requires resources. So we thought, if we would, we are not the first ones to do that. Actually, Louis Dreyfus and Cargill were running their own asset management businesses. Louis Dreyfus, it was Endesia, that was the name of the hedge fund, and Cargill was Black River. They were running asset management businesses, allowing external investors to get exposure to their know-how, to this expertise and that edge.
And what's that word? I'm missing that word you're saying. No-hold? What is it?
The know-how, right? Your expertise.
Got it. All right.
Know-how. That's my bad accent.
Yeah.
So when we kicked off 5 years ago, commodities managing or expanding the footprint, we thought, it is important for us as well to bring the ability to get more resources to spend on analytics, on developing that edge, and that we will only be able to capture by managing third-party money. And so that's how we came to 4 years ago, actually, for your firm. We got into, we've been helped by some of your colleagues into scanning in the CTA space, and we thought, the best way for us to get into that business is actually look for a platform. This is a business that is new to us. We've always been managing our shareholders' money, our own money. Managing third-party money requires a know-how. And so we started to scan the CTA space in the US, and luckily got connected to Jonathan Tulukov, the founder of Commodity Asset Management, a great metals specialist. And John realized, so we actually started by investing as an investor into CAM, and then we realized that we are very much aligned in how we see the opportunity, and the vision very fast was to say, we want to have this platform. So we acquired Commodity Asset Management, was acquired by ETG 2 years ago, with a view to use it as a platform to offer what we think is the first existing multi-strat commodity fund and SMA. And when we say multi-strat, let me, because that's a very hype word.
It's a loaded term.
It's loaded and hype, and I just want to make sure. I think it's one of the things that is interesting to discuss around the commodity space and derivatives. It's multi-strat means you have a diversification in the number of assets you trade. But that statement, you can make it for any CTA. I mean, they trade all the possible markets, right? So diversification is not in what you trade is not sufficient to describe it. When we say multi-strat, we wanted to inspire ourselves of what we've been doing on behalf of our shareholders for a long time, and what multi-strat funds are doing for their investors, which is essentially to create a product that resolves some of the issue that people have had historically with commodity funds, which is the volatility, the profiles of risk-adjusted returns. And so, when you're employed by the Cargill, Louis Dreyfus, etc., at the end of the day, somebody is watching over your shoulder to make sure you don't blow up the firm, right? And you are dealing with highly volatile commodities. We discussed freight, but coffee is another one that's highly volatile.
And in practice, you're given a budget. You get to trade this much, and you can only lose this much.
Exactly. So the only way to approach that is to say, you've given a budget in terms of maximum losses, and then the know-how, I guess, that we've developed over the years of managing so many different traders is to realize that you have to give them the room, and probably that explains why some of the big multi-strats are sometimes struggling a little bit with commodity traders, because you cannot expect the same volatility profile in commodities than you have from an FX arb strategy. But at the same time, at the portfolio level, you do want to have that profile of stable volatility and risk-adjusted return. So multi-strat, in the sense of having what we build so it was our internal desks that we ring-fenced to offer them as a product to investors, and where we bring both fundamental, discretionary trading in all the commodity groupings. So, grains, oilseeds, soft commodities, energy, metals, freight. Those are specialists. So real people that are experts coming from the physical background, understanding the optionality and the complexity of the physical commodity, and then a lot of analytics, internal and external analysts, a fair bit of money that we spend on that to get a view on each of those commodities in terms of supply demand. But then we add hybrid pods that I oversee and trade directly with my team's hybrid pods. So one of them is that we take all those models, analysts, brokers, in some cases, but let's say the vast majority being our internal analysts and some specialist external analysts that create those fair value models on each commodities. And we take them through a systematic process and algorithms that rule-based, that use price triggers and different temporalities to then deploy risk. Then macro, we've discussed a little bit in commodities. I think one of the things that has changed in the last 30 years is, well, actually it's not true, because if you look at the 70s, the rallies in crude oil and corn in 73 were driven surely by fundamentals, but as well a lot by the end of Bretton Woods in 71, right? And inflation cycles. So macro can always be a significant driver, but I would say you get the sense that the macro input into commodities has grown over the last few years, and very clearly during COVID period, and most recently, the inflation round, and then the geopolitics, tariffs. Tariffs are a very big driver of commodities.
Right. We'll stick a pin in that because I want to. Right. Tariffs, you could argue, might de-importantize macro, right? If it's less of a global trade.
Yeah, but at the same time, remember commodities, there's a lot of with substitution in commodities.
Yeah.
What happens is that if tariffs are put on certain commodities, certain countries, what will actually happen is you radically change the supply chains and the flows. Overall, as a planet, you most probably will still consume maybe a little bit less because you push demand a bit lower. But the most critical thing you do, you change the flows. And that has a very direct impact on spreads and on relative value. And that has a big impact on then the derivatives. So I think macro, we approach it with, and that's what I've been doing for 30 years. It's really, since I was in freight and Dreyfuss, is, how is macro playing out into the specific commodities? And so that pod then as well has this macro view. And then there's a systematic process to define which commodities and directionally what we do. And then we have allocated. We've worked for a long time. I've been very lucky in my career since the end of the 90s to work with very bright mathematicians and systematic people. So actually, I know very well that space actually, even though I've never fully myself embraced a career into it, but I've been coding personally more than 1,000 strategies in my life. So a little bit about that, and most importantly, I've been lucky to have partners that with whom I'm working since, in some cases, more than 15 years, actually even 20 years in the meantime.
So you use the word pod, right? So Multi-Strat, Podshop, do you consider them synonymous? Same thing?
Exactly. So we have 8 pods currently, which is 4 pods of the main commodity groupings and specialist fundamental, then 2 pods hybrid, the model-based and the macro, and then 2 pods fully systematic. One internal, which is mostly driven towards quantamentals. So what we do there is we use, and that makes us a bit different, a lot of fundamental data to turn them into inputs to deploy into the different commodities using some price elements, but mostly fundamental data in a non-linear way. So, as well, I think that's maybe something always interesting to note is that commodities, distribution of price in commodities is actually different than financial markets. You tend to have fatter tails, more kurtosis. You tend to have those drops in liquidity or burst in correlations that you don't have in some other markets. And that creates a very interesting profile in terms of how you approach risk management. And so we do use that into our quantamental analysis, and that's fully systematic. And then we have a pod that is a partner of ours. It's actually a partner of mine for a very long time, probably 18 years. We go back, and he's very famous, or he's very well known in the CTA space, been around a long time. Rafael Molinero Capital. He's been a trend follower, traditional with Rotella. And I think Rafael, with us, the last few years, we've worked a lot on research, shared research, so that he's still a pure CTA. But let's say that maybe when we started working with Rafael, he was Molinero, there were like, I don't know, maybe 75% trend followers or 80% trend followers. And today, I think in his portfolio, it's maybe down to less than 15%, I think 10% trend. And the rest, so we tried and we worked together to adapt a CTA model into the idiosyncrasies of commodities because they have a different behavior, right, as a group.
Yeah.
Without falling into the pitfalls of data mining and optimization, not at all, but nevertheless, there's different behavior. And we think that's very interesting approaching commodities. So in that sense, we're multi-strat because we do approach it all commodities. So we trade all the major commodities on the major exchanges through 3 or 4 different approaches, right? Purely discretionary, fundamentally driven, then model-based, macro, and systematic. And I think for us, in my having been in commodities for 32 years, I've realized that if you focus your attention to just one type of commodity, you may suffer from long periods of times where there are essentially no trading opportunities.
Yeah, or you force it, and then you're trading when you shouldn't be. Yeah,
exactly. That's one thing. The other thing, what I've learned over the last 30 years, and I think this movement is increasing, is that 30 years ago, you could say there's no reason to trade commodities with any other approach than fundamentals because there was an informational edge if you were sitting in the big firms. That informational edge has reduced because, for example, the impact of weather on agricultural commodity today, most funds or market participants will have the same information, and squeezing out an edge on weather today either is super highly costly or the edge you create is so marginal in terms of your peers that, you
Costly
can
in a different way. Yeah.
Yeah. So I think what the other vision we have is that we've learned that you never really know what will be the next big mover in a commodity. Is it your fundamentals? Is it geopolitics? Is it macro? Is it the impact of CTAs, non-linear models, and all the space of sentiment-driven. We've seen, I think it was 2 years ago, something like that, the type of memes that we saw in GameStop. I remember for a few weeks some of the same crowd getting really excited with corn on the ETF.
Yeah. Yeah.
Right? So how do you deal with that, right? So I think what is very interesting is like putting together those different layers and dimensions. And then, of course, multi-strat as well, because on top of it sits a very structured risk management so that we are on more or less on a constant volatility. And more importantly, with a defined maximum drawdown. So to go back to our initial conversation, the mandate we had for our whole professional life, that's the same mandate. We are building the machine or the system, the overall system, so that we don't break a maximum drawdown. And I think that makes us different. And I believe it makes us different. And as we are launching, it feels that people are interested by that. And I think we solve a little bit of an issue, right, in the industry. I mean, if you are a big institution and if you want exposure to commodities, you have to invest in many different commodities funds with their own volatility, and it's complex.
Yeah.
Yeah. So we want.
What is the profile you're trying to get? Like a commodity profile that should do well in inflationary times, that kind of thing, or just an absolute return?
Absolute return.
Yeah.
We don't really. I think having started our careers in many of us in agricultural commodities, some of us in energy and metals, but many of us in agricultural commodities, we realized that this idea of super cycle in commodities, we kind of struggle to buy into that. Yes, there are some super cycles in commodities, especially in industrial commodities, due to underinvestment. Yes, you do have periods in history where if the dollar gets debased, by definition, you create an environment that is highly bullish for commodities. But as well, you do have human ingenuity and productivity means that our yields are constantly growing. And the usage of commodity in the economy, the impact of, say, crude oil in the production of 1 point of GDP in developed economies today is a fraction of what it was in the 70s, right? So we have, everything in economy is transformation of energy. But nevertheless, we've been able to create more GDP out of a single unit of energy, right? And so overall, commodities have those cycles. What we think is very interesting for the next 10 years compared to say, a difficult period for commodities in general was, say, 2014 again to 2020. And that was a period where there was no real story fundamentally. There was no real story macro-wise, etc. And there was a big cycle of underinvestment. And then since COVID, there's a bit of a different shift. But I think what people must realize as well, and what's we like a lot in terms of potential opportunities going forward, is there are a few things that are significant. We have a change in the global monetary regime, and that has an impact on the dollar. We have obviously big shifts in geopolitics, and for commodities, that's very major. If you go from a world that is US-centric to a polarized world with, say, in the future, 3 blocks, the US, Europe, and Asia, Southeast Asia, it has very significant impacts in terms of commodity flows. Then there's something else which we find, and we track very closely, of course, and it's very complex. It's the impact of weather change on commodities. And last year was a very good example where soft commodities, so essentially coffee, cocoa, sugar in a lesser manner, but as well. They are produced essentially, think of those commodities as commodities that are produced in a relatively narrow band of the planet, right? Between the tropics or a bit more than tropics. And then you have your grains and oilseeds that are essentially, for most of it, produced outside of the tropics, right? Above and below. So what seems to happen for the last few years is the variability of weather. And again, it's not bullish or bearish. It's the variability, heat and rainfalls within the tropics has increased dramatically, whereas variability of weather outside of the tropics has not increased, but on the contrary has kind of shrunk. So what does it do?
On the whole, maybe it's net even, but it's concentrated in the tropics then.
Right, the variability has increased there. So what does it mean? Last year, well, you have quite exceptional the last 2 years weather conditions that have affected cocoa, in a lesser manner, but still in sugar. And you look at those charts,
cocoa was amazing.
Yeah, coffee is actually amazing as well. It's been and even sugar, has rallied quite a bit. And on the other hand, look at soybeans and corn. Those markets have dropped because those crops at the end were quite good globally. Wheat and so the weather variability within the tropics clearly has increased. Outside, it has decreased. Now, how stable is that? And if you read through all that material, it's very much has a lot to see with the sea currents at the global level on the planet. We have turned into a more unstable environment. That's my point. And if you are able to understand what it means and track it, that's.
So you're saying weather has become more volatile, basically.
Well, I'm not saying that it's within the tropics, yes, but outside of the tropics, actually not. So that's why we don't have, when I started my career as a wheat trader in Louis Dreyfus, the Russian winter kill was a topic almost every year. You had a fair chunk of the Russian wheat crop was affected by winter kill or very strong heat in June. The last few years, look at those crops. I mean, you don't have almost any winter kill anymore.
Yeah.
That means a much more stable wheat production in Russia. Same story in corn. It seems now with technology and the way we produce, you just need the right amount of rain at the right precise day you need it, and you make your crop, right? So the viability of yield has actually decreased in grains and oilseeds. So that's my point, the last few years, where it had increased dramatically in soft commodities. And that's due to weather change. So what does it mean?
But I could also argue the soft commodities has less tech, less investment in the yield increase. I don't know if that's true, but from my...
I would say so. I think it's
so that might be part of the equation as well, right?
Yes.
Let's take 2 steps back. Why does ETG, why did Dreyfus before want these groups? Just to add some more profit to the bottom line, or to diversify their revenues? Like, what's the end game for them?
Yeah, I think so. Obviously, it's having a fee-based business is an interesting mix to the quality of your earnings. But honestly, the most important driver is that remember, we are belonging to groups that are highly diversified, that are present in so many jurisdictions and so many businesses, that we have a limited pool of resources to allocate. And especially, it's not the purpose of the firm to be speculating, right? You cannot avoid it. You have to risk manage, but it's not the end game, right? So for us on the prop side, the main driver is that by raising third-party money, we can spend more money in analytics, in having more talents, in being able to better understand each commodity, giving a better return to our shareholders, a better synergy, but at the same time, by doing so, you increase the diversification for investors. So it's very much of a positive feedback loop, right?
Yeah. So you get two-way flow. So ideally, the Podshop's going to give flow to the physical traders of like, hey, here's where the systems are lining up. Here's what we're seeing from our models.
Exactly. So we obviously it's a Chinese wall on the trading side. I
Yeah.
mean, the physical traders have no clue what the fund does, and the fund has no clue about the physical. I mean, the Chinese walls are very strong on that. But on information, on intelligence sharing, it's fully transparent.
Yeah.
So the guys that sit on the pods understand and have the same information on analytics. And to give you some example, I mean, we last year was a really, really interesting year, and we did quite well last year because we are, as a firm, ETG is one of the top 10 global coffee trading firm on the physical side. And our traders, they have the ability to understand much better the pricing of the physical commodities than if you sit in a bank or a hedge fund, because you actually deal with those big consumers and you realize you can develop some models to understand the supply demand of pricing, right? Of the physical pricing. And then if you identify an imbalance there, which was the case last year, plus you have our internal agronomists and agronomist models. You identify the variability in the Brazilian weather after a year that was bad in Vietnam for Robusta coffee. If on top of it, you see that the spec community doesn't pay attention to coffee because it was trading low prices, low volatility, then you have a very interesting configuration and that explains really a lot of how powerful that trend was. And it's the same story in cocoa, but cocoa is a very small commodity, right? So coffee, Robusta, Arabica is actually already a little bit bigger. It's been a bit the same story in sugar. And I think, so for us, we need to be making the best out of the physical footprint, but by managing third-party money, we can add capacity in terms of analytics from a top-down approach. And of course, the end goal is a multi-strat strategy. It's a bit of a big word to describe yourself as a multi-strat with 8 pods. I'm sure that if some of your listeners are working with the great multi-strats, they say, "Oh, this guy, what is he talking about? 8 pods, it's not multi-strat, right?" So that's why I'm stressing that it's the philosophy of multi-strat in terms of risk management and diversification. But of course, our end game, what's our end game? To get to our maximum capacity towards 25 pods, 30 pods. I don't think you can go beyond 30 pods being a pure commodity player. There's only that many ways to really.
I don't know. I see groups that have like 20 power traders just themselves. So you could do it, but it would start to get specialized and stuff.
Yeah, and I think it's a good point there to make there. The other thing we want to make sure, because you can go really big, just essentially being an energy trader that does a little bit of the rest.
Yeah.
We want to keep it balanced between ags, metals, energy, freight, and some macro-linked FX. Especially a few currencies that are actually driven by commodities or that have a very big impact on commodities, and you need to have that in your portfolio. So we want to be balanced. For us, it's not about the privilege of being backed by a big group like ETG is that maybe we are less in a hurry to get any mandate to go real fast, and then you realize you need to hire more energy traders to be able to manage your book. We have a very clear defined strategy. We have a clear view of where we want to go, which is having a very balanced overall commodity exposure to offer to our shareholders and investors without being just another energy fund that does a little hide things, right? That's not what we want.
And talk 2 more questions just on the pod structure, the multi-strat structure. One, how do you compete with these huge firms you just sort of mentioned to get this talent? Absolutely. Or do you think like there's maybe talent that's not getting put into those shops because they're commodity focused?
I think, it would be arrogant on our side to believe we can compete with those great structures because they have resources we cannot have. They have technology that we don't have. So we, I think, try to displace the in a way the battle, I would
Yeah.
say, by making sure that we offer a place to commodity traders that is more commodity traders friendly. If that makes
Yeah.
sense. In different aspects, right? So the first one is that from a pure commodity trader that has his background and in physical commodity, even if you're in one of those very big shops and with all the resources they have, at one stage, you kind of start to lose a little bit your edge because to get this physical feel, you need to be active in the physical side, or at least very directly connected to it. And just out of some, you know, information flows that it's not by paying physical brokers that you will get the information.
Yeah.
So I think the first thing is
Right. It seems like they could buy their way into that, but you're saying no, it's like dozens of years of boots on the ground of figuring out logistics and contacts and
yeah, and you know, it's a give and take, huh? It's you still need to be, you know, involved in the physical side. I think that's our prop traders. So we offer them a platform where they have this connection to the physical. I can give you one example that's quite interesting. We have a very talented grain trader with us that has been for 15 years in a hedge fund, but a hedge fund run by our ex-mentor from Louis Dreyfus, a no spray wingspan hedge fund, and he's been with Bruce Ritter for a long time, and I think, you know, then he's been involved in some other big funds, and I guess for him being with ETG, he again finds this edge of the physical driver. And I can give you an example where in the last few weeks, at one stage, if you remember, after the Zelensky-Trump meeting and the tension that came out of that, and we had a very steep sell-off in corn futures, Chicago.
yeah.
So one of the things that happened there is that the physical corn, and it was the tariff, the worries around the US tariffs as well, obviously. But one of the things that happened is that our traders were able to track in real time very, very aggressive offers on the physical corn into destination countries that were a reflection of the worries around the conflict and Ukrainian sellers dumping their corn. And that undercut then the US corn competitiveness. And you know, so those moving parts, sometimes they're really the trigger. On top of it, you had the CTAs that were quite long. Then the tariff discussion came in. So you get those little moments where the tipping point can be actually the physical pressure. So if this very talented grain trader would be sitting at, I'm not giving name, but one of the big pods shop, he would not have this information. So they see the value of that. So that's the first point. The second point, as I mentioned initially, I think we've seen quite a bit of churn in those big, historically, you know, in those big multi-strats. And I think the reason for that is that it's very hard for a commodity trader to be able to fit within the risk mandate that you have in most of those shops. And I think where we are different is that
they have a tighter leash in plain speed.
Yeah, the leash is really probably too tight for commodity traders. And I think the art of what we do, having managed traders, you know, and myself, I have been a trading manager for 26 years, you know, so you learn to say, okay, I know the profile. Now, how do I, by binding them together, and that's the idea of the multi-strat, different approaches, etc. By putting that all together, how do I make sure that at the portfolio level, I have the type of stability I'm targeting, even though I give at the single dimension a bigger leash, right? And more. So we have a different approach in that, I guess, that is some very senior commodity traders realize that, you know, it offers a space for them that is more favorable for commodity traders.
And you touched on my next question was going to be how important is that center book, for lack of a better term, right? Of the big multi-strats will say, hey, it doesn't quite matter what all the pieces are doing. Our risk management, our center book controls all that. I think there was a paper out. We'll try and remember it and put it in the notes that basically said you could put all these bad strategies together, but if you have this risk management is where the key is, more so even than the talent underneath.
Yeah. So we don't have a central book. We don't believe in a top-down approach, but what we do is that we have assumptions of the trading profile and personality of traders, right? A fundamental trader, you have different types of fundamental, but say you have a value trader, somebody that his decision making is driven by value. You can describe them in some aspects as deep pocket traders.
Mm-hmm.
Obviously, if you have a value-driven approach, the cheaper something you get, the more bullish you have to go, and if the higher it goes, the more short. That has obviously a certain profile of risk to return, and you can make assumptions on that person. So we screen them, we know them, we manage them, and I feel there's something else which I'm not here to sell Gamma. My idea is really to discuss commodities and trading, but I think we do something unique in Gamma, which is that we actually have an incubator whereby with our ETG money, we have those pods trading ETG money for at least 1 year before they actually can join the pod. Why do we do that? We know when we hire those people or they are with us, we already know their trading personality profile, but we want to see them doing a full year of actual trading, how that fits to the portfolio. So we have assumptions on a trading personality, so deep pocket type of value traders, very different profile of relative value commodity traders that trade mostly calendar spreads, right? And that's actually calendar spreads are probably a more pure way to trade fundamentals than flat, because flat can be altered by so many things. Relative value spread traders, they would be sitting almost in terms of trading personality profile on the other side of the spectrum. They are your grinders. They tend to grind constantly. They don't shoot for the stars. Profile. They're not gamma short, but they have more of a profile where you need to be careful that they don't get overrun by a big systemic wave. The very opposite of. So we make these assumptions on that personality, and that means that in the overall portfolio, it gives us an optimal allocation in terms of drawdown, right? Now that sets a basis of 100 for each of the pods. Then we have developed tools to identify market regimes. So if you are a trend follower, a value trader, directional, you tend to do well when the market was in low vol, starting to go into a more volatile environment with a directional, so a linearity. That's when they tend to do well. They tend to do poorly when the market is shrinking vol constantly in range-bound environments. So you make those assumptions and you identify those regimes, and that's a quantitative process. And that means that you have a first rebalancing on a monthly basis where you can go from the initial 100, it can go as low as 50% or as high as 150% of the initial allocation. So it's a dynamic risk allocation. That's doubled up with P&L management. So we have a very simplistic approach, which I've done for 30 years or 28 years managing commodity traders. It's maybe simplistic, but it works, which is say, if they lose money, you cut the risk. If they make money, you may increase the risk. But we have an anti-martingale approach. So we blend that together with the market regime, so that it's not disconnected, they work together. And then that gives you, on a monthly basis, is now your trading risk 100 or 110, 120 or 80, 70, based on those things. And then super important, because we've seen in our world of the physical commodity, we've seen firms blowing out. I mean, I've lived the end of Continental Grain. That was a big firm, or Groupe André, so maybe less known name, but those firms blew up not necessarily because of their commodity business, but because they were leveraging themselves up into other things, and they blew up. But we've
Or
seen
Amaranth in the hedge fund space.
Amaranth, absolutely. You just dig a hole by not respecting the risk, right? And so what we do as well, I think, as an overall design, and I think it's very important for people to realize that in commodity, the way to approach risk is you cannot VAR will not help you. Okay, that's a backward-looking way to look at risk, and especially commodities having this characteristic in volatility. VAR is essentially useless, to be very honest.
Yeah.
What we do is drawdown management. So we allocate a budget, and I remember you can navigate from 50 to 150, but then you have your budget of risk. If you draw down a third of that budget, we have a risk committee and we discuss with those commodity traders, why is it concentration risk? We don't challenge our traders or strategists, say, why are you long or short? So we don't have a central book that says, I know the market goes up, so I'm overriding your short. That's a conversation. It's, why are you there? If they draw down 60%, then the risk committee has actually the authority to cut the sizes. Because very often for commodity traders, especially for value-driven and fundamental traders, they can start to be a little bit sticky.
Married to the position, yeah.
Exactly. So the risk committee is then cutting the sizes. They can still be sticky, but not with the same size. So, and
But is it hard for them to ever bounce back then, to ever get back in the green? Or because they have these outlier moves that
exactly. So, and the other thing is, remember, we are very dynamic in that. If they start making money, we then increase their risk. If we realize, so we measure a lot the quality of trading. I've been very much influenced in my life by a few books, and there's one book that is not directly I've read many trading books. Like I know you do, and you did, and you're extremely knowledgeable. But there's one book in decision making that I find fascinating. It's actually not written by a trader, and the book by Annie Duke.
Thinking in Bets.
Yeah,
I mean,
exactly. Thinking in Bets, Annie Duke. I think for me that's the essence. It's helping, because remember, commodity trading, it's like any other type of markets, but in commodity trading, you really have to build a view, right? And so, for me, there is a very smart guy in Europe. He's a macro guy that is running a hedge fund, and Alfonso Pecatrolo, and he's always saying, trading is opinion strongly held. No, you have to have strong opinions and you have to hold them weakly, right? You have to,
not strong.
And that's I think is super smart, because in commodities, that's the issue, is that I've seen in my career commodity traders doing a lot of work to build a strong view and then being too loyal to that view.
Like Pierre Anderon, right? Like, would you have him in your book if he's like that profile? It's too all or nothing, right?
Yeah, no, that's not what we do. And maybe because of lack of talent. I don't think any of us is as smart as Pierre Anderon. I'm surely not. And maybe, we see ourselves more as grinders. We see ourselves more as being in everyday's grind and not the big view that will make you the year. It doesn't mean we cannot capture some outliers. Again, we had really an exceptional year last year, and it was on the back of our soft group pods doing exceptionally well in coffee. So, but not because we bet the house, not at all. It's just that they've been able to deploy very nicely into that theme, riding with it, and it's very good to us, but not because we are betting the house on one view.
How do you keep everyone happy? Like, if you're cutting someone's risk, is their income going down? You don't have to get into specifics, but like, if I'm a trader and I'm like, well, my income just went down, how do I deal with that?
Sure. So, remember in the multi-strat world, one of the very essential components is that each pod has to be ring-fenced. You have a pass-through cost to your investors. Us as ETG cannot bear the risk of the netting risk between the pods. I mean, you cannot attract a great trader by telling him, you know what, your bonus will be dependent on your colleague making money. It just doesn't work.
Well, that's what happened at banks, where all these traders left the banks because they were getting netted out and they got upset.
Exactly. You cannot. So how do we attract? I mean, the netting risk lies with the investor, and so a trader that doesn't do well, by cutting his risk, we actually protect him to limit his drawdown. So that they understand that quite fast. As you know, if you draw down 50%, you have to return 100%. If you only draw down 25%, you only have to return 30% to get back to even. So we are absolutely not in a linear world when it comes to drawdown. So our aim is to make sure we give them the ability and the leash not being too tight, but at the same time helping them to say, hey, let's work it out so that you don't draw down more than 50% of your risk, because you can come back and we'll be increasing your risk as you do well, etc. So we had a few pods. So by launching CAM, we actually ring-fenced those pods internally with ETG so that we can show a track record. We have around, I think, 4 or 5 years of track record that we can show. And some of those pods have actually drawn down 50, 60%, I think one even 70%. Nevertheless, they are still there. They're still part of the structure and they are coming back. So for me, this is really the essence. How do you help commodity traders to navigate the volatility of markets? How do you give access to investors to this very nice uncorrelated revenue stream? And today, I think probably something that will be more important in the next few years than it's been in the last few years, just because, and maybe I'm wrong, but I get the sense that we are ending the financiarization of the economy, that, Main Street will take the revenge on Wall Street in a certain way, not only in the US, but globally. And that means commodities, at the end of the day, we transform still stuff
into other stuff.
Right? So I think for us, we want to be able to offer that to our vision, and the vision of our shareholders is, commodities provide an opportunity, and you can do good to your farmers in Africa. That's the mission of ETG, and it is a fantastic story in that sense and very inspiring, And we try to do the same as CAM. We are connected to this philosophy. Say, okay, how do we bring a risk-adjusted return product to the investment community? So we target, institutional clients, your pension funds, your investment platforms, big family offices, but and as well we thought as well, we have a hedge fund, a retirement fund that allows for smaller tickets for wealthy people or people that want to diversify. So it's really this idea. And again, the more we raise, the more we can invest. That's the idea. The more we can have a stronger analytical framework, it's money, it's resources.
You got a fan in us of going to be cheering on the commodity pod shop, right? To combat with all these big equity pod shops, or what would we call them? Financing pod shops.
Yeah, exactly. And I think, it's very clear that, we can prove it. It is totally uncorrelated to the other asset classes. It's more uncorrelated what we do to your bonds and equities than CTAs. As such. CTAs are exposed to the same asset classes, right? So even though they provide great diversification in moments of stress, at the end of the day, for us, we are agnostic, bullish, bearish, and again, most of the times we are both bullish and bearish. I mean, some strategies may, because we trade all those commodities through those different layers and dimensions, right?
Let's finish it off with a little bit of fun here, and ask if you could go back in time and trade one sort of major market event, what would it be and why? How would you do it?
I was born in 1970, and I wished I was already adult when Nixon came out on TV saying that it's the end of Bretton Woods too. But that unleashed, right, as a trader. Then first, the dollar, and then, the OPEC suspending or cutting their quotas, and then the disaster in Russian grain crops in '73, and the Russians stealing U.S. grain. So between '70 and '73, but it kicked off with this moment where Nixon comes out on TV and tells the world, you know what, the world you know is gone, and it's a new world. And I would love it because you know what? I'm a trader. So for me, I'm driven by the next trade. And I
Yeah.
believe we are back in a moment like that,
What I don't know the history of that, of like, what was there electronic trading? No. So like, how did that first trading day react? I don't even know. Like in the dollar and gold and all that stuff.
Yeah, so obviously gold popped up immediately, right?
Yeah.
So you debased your currency immediately. The dollar got debased in one shot, and that ignited then all
Yeah. But was it like 5%, 10%? I don't know what that next day's move was. We'll look it up.
I think I have it still here. I can tell you that, but it was a quite a significant event indeed. So the day it came out, essentially adjusted by inflation. Okay, so if you take gold adjusted by inflation, it went from $295 in September '70 up to 1,200 in April '74. So it kicked off. It kicked off a movement, right? The initial movement was maybe price going up by 20%, but then
Yeah.
it kicked off a trend that lasted into the peak of the '80s, right? For me,
Yeah.
it's not that much the impact of one day. It's
What it started to
looking back,
snowball.
right? Exactly. What does it mean in terms of then the world changing? And as a trader, if you read those great books and stories around great traders, some of the most iconic traders were actually born as traders in a certain way
Yeah.
in those '70s. Like Ray Dalio is an example, and that's really when Warren Buffett in equity, but equities was the same approach at the end of the day. It's if you understand those moments in history where history changes and you're able to adapt, you can really do well. And we get the sense that we are in some kind of similar moment where Bretton Woods has been killed by the US 2 years ago, essentially, when the US seized the assets of the Russian central banks. That was a message to all say, the US Treasuries is not the safest asset anymore. And now you see
Yeah.
the consequence the last few weeks with all the evolution of the US policy and people starting to freak out, say, hey, US Treasuries is not, it's a fact, it's not anymore the
Yeah.
safest asset in the world. So what
Which
does it
is,
mean?
yeah, it's odd to me, the big, huge bounce back when like a little bit the genie's out of the bottle, right? Of like things have been said, things have been done that you can't just undo.
No, you cannot undo, right? So you get that sense that we are living through historical moments. And as a trader, I would have loved, I've studied that quite a bit. I know my
Yeah.
sequence on crude oil, corn, and the whole story, and Bretton Woods ending,
But
etc. But one thing is to study, look at, study them. But as a trader, I know that it's when you feel it in your bones that, really, you can really understand. And I wished I would have been alive back then as a
yeah.
trader.
What
Yeah.
were you feeling in your bones last week when silver was down 15% and then rallied? Were you
Very good
keep
question,
earning
Jeff.
your
I
risk
can tell
management?
you,
Yeah.
I have no stress when I'm trading. People that know me, my team knows I'm not, I don't stress when I trade, and it's maybe because we are so structured in how we do things. But the last time I could not, it's not that I could not sleep, but where my brain was so
Yeah.
excited that I was waking up at 2 o'clock in the morning, checking out things and sleeping again, and just the feel, the huge of being understanding, connected to it. That the last time it happened was October 2008.
Yeah.
I
We were
think
saying in the
oh,
office, this was ranking up there with the flash crash,
oh,
08.
yeah,
Yeah.
yeah, absolutely. I think it was, for me at least, last week was more intense than COVID, clearly. And And then, you have multi-strat, you have multiple pods as the CEO, CIO. You just want to make sure everybody is fine, and etc. And I'm super proud of my team because we actually made money last week.
Yeah.
We had low volatility and made money, which is, for me, what I think is most important is when you have stress, this concept of Nassim Taleb anti-fragility.
Yeah.
We are driven by that. We want to be not being resistant. We want to be able to strive when things get really stressed out. So, for example, as a firm, that was the genetics I got in Louis Dreyfus. We do the same in ETG and we do the same in CAM. None of our pods has a gamma short profile. It's not allowed. I will not hire.
Yeah.
Been asking about the volatility of Endurance. I believe the most important thing is that you need to understand where your edge is, and we want to play in a structurally inefficient space, right? And the structurally inefficient space for us is the connection between the physical and the financial side of commodities. We want to make sure that what we do is, uncorrelated, for structural reasons with the rest of the environment. So we try to approach it with a way that is, we don't do the type of strategies that the banks would do or most hedge funds would do. You need to make sure you're uncorrelated. You clearly, my focus of attention is making sure people have an expertise. There's just no shortcuts. You cannot think you can approach the commodity space by just doing a plain vanilla rule that works on average. You have to have domain expertise, and then understanding the risk and how to articulate the risk around that portfolio, and so that's really what. And so last week for me was really, if you put that all together, it was I couldn't sleep. I could not sleep. So it's
You're
funny
excited.
because my co-CEO of CAM, Jonathan Tulkov, the founder of CAM, it's funny because he was telling some investors that it wasn't a week business as usual. It was quiet for us, and it's true. It was quite P&L wise. But me, I've slept.
Your brain, that happens to me in Las Vegas, not because of the gambling, but like the math of it all. I sit there and then I get back and I'm asleep and my brain's like seeing all the cards and the numbers and doing the math.
And then you wake up, right? And you get that excitement. And for me, so last week was really that. And I've think for us and for me in particular, trading commodities, physical commodities and derivatives for such a long time, it's a passion around human behavior, really. And so last week was one of these moments where, as well, by having the ability to understand, behavioral biases and how to mitigate the impact on our trading, I find that fascinating. I think that's when you feel you're alive, and in the zone, and you connect those dots.
And it's more fun. We're beating the robots. We're beating the AI when we get to feel something, right?
Yeah. Well, that's a topic for another discussion, Jeff, because AI has a lot of many things to say on that.
We'll do that on our next one. All right, Stephane, thanks so much for coming on. We talked through the darkness. It got dark in London from when we started to when it stopped. So we'll talk to you soon.
Thank you very much. Thanks for the invite. Pleasure.
Yes, thank you.
Bye-bye, Jeff. Bye.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.